I'm going to try something a little bit new here for Chapter 4 and I guess also for Chapter 5. We'll kind of see how it goes. Might be better to just continue on. I would love to hear or read your responses if you want to send me emails about whether you prefer videos or just me or looking through the text. Anyway, I'm in Wiley Plus. You've been in here now for a while. You've done some homework here, and your home page, your main page, won't look exactly like this because I'm in here as the instructor. But you'll have, I think, these 3 bullet points. In Read, Study, and Practice, you can find a bunch of stuff for every chapter in the book. All right, the reading content area here is it's just directly from the textbook. So it's all the study objectives, the end of chapter problems. It's just an ebook version of what's in your text. And then below that, there's some really good stuff it's available to you as far as resources are concerned. This Mastering Chapter 4, and it's there for every chapter, has got some good stuff. Links that you can look at, interactive things. This review tutorial kind of walks you through all the study objectives, gives you the highlights of the chapters, demonstration problem. It kind of presents a problem and it has you answer some questions throughout the process. There's a tutor link here, and there's a bunch of other things that you might find useful. Flashcards, crossword puzzles, good for terminology. I'm going to go to the reading content now and start to just go through the study objectives. I'll make the screen bigger here. All right, study objective 1 is about timing issues. We're talking about revenue recognition and the matching principle in this section. The revenue recognition principle is all about the idea that you have to record revenue when you earn it. Okay, we're going to talk in a second about methods of accounting, cash and accrual, but the revenue recognition principle is one of the central principles in generally accepted accounting principles, GAAP, the set of rules that governs how transactions have to be recorded. It says that you recognize revenue when it's earned, all right, not when cash is received. You can see journal entries right here. When you earn revenue, you credit revenue. All right, we've learned that in Chapter 3. And then you debit accounts receivable because when you're earning revenue that you're not getting paid for yet, you have to record the revenue, but you can't record cash yet because you don't have the cash. So you record this other asset called accounts receivable, which is an asset that is used for when you are going to receive money but you haven't gotten it yet. And then when you do receive the money, you can credit or reduce that receivable and show that you've gotten the cash by debiting or increasing the cash account. The matching principle says that you have to, it's all about expense recognition. When do you record expenses? The matching principle says you record expenses when you incur them. The book also talks about expenses following revenue. So costs you have to incur in order to make revenue should be recorded or recognized when you incur them. All right, not when cash is paid. There's a little diagram kind of explaining that along with the time period assumption. The cash versus accrual basis of accounting is discussed here. You can see there's review animations. So if you want to have it explained to you by an author or narrator, you can click on these interactive links. Accrual accounting, let's see, accrual accounting and the cash basis of accounting are described here. Accrual accounting means that you're going to record revenue when it's earned and you're going to record expenses when they're incurred. All right, it doesn't follow cash receipts or cash payments. Cash, under the cash basis of accounting, it's just that you record revenue when you receive money, payments, and you record expenses when you make payments. You can look through this example that shows you how you would mismatch your revenues and expenses if you used the cash basis of accounting, and this is why the cash basis of accounting is not allowed under generally accepted accounting principles.